Kia ora, this is Mr. Wilson going through how to do depreciation schedules. What we have is a business here called Wairoa Farms, and they've got three assets: a tractor, a truck and a log splitter. And so what we're going to do is we're going to depreciate these assets using the straight line method of depreciation. These 1, 2 and 3 tables will fill in order to give us information for our financial position statement in 2024. So what we're going to start with is the tractor. The tractor, we can see it's got a cost of $60,000, so type that in. The opening book value is the same as the cost. Now the depreciation using the straight line method is going to be equal to, you're going to need to open your brackets, the cost minus the residual value. The residual value is the value of the tractor when we think we're going to sell it. We think we're going to sell it in 5 years' time, so the residual value, or the value left over, is 10,000. So we'll see that value of the tractor will go down 60 minus 10,000. It'll go down 50,000 over the 5 years. So we'll divide it by 5, the number of years, to tell us how much to depreciate each year. That's 10,000. Provision for depreciation is an accumulative amount. In the first year, it's just the $10,000. And the closing book value is equal to the opening book value minus the depreciation for the year. So in our books, that tractor is worth $50,000 at the end of the year, being bought for $60,000, depreciated for $10,000. The opening book value for the following year, 2021, is the same as the closing. If you like, value bought down. Depreciation is the same every year using straight line. The provision for depreciation is cumulative, so we're going to add this year's depreciation to last. So in total it's gone down 20,000, and we can fill this down. And while you're at it, we may as well fill all of them down. And so what you see is that the depreciation every year is $10,000. The provisions for depreciation, the amount we're writing off every year, climbs as our depreciation continues, and the book value decreases. So after 5 years, we've reached our residual value at the end. With the truck, we'll do the same thing. So we'll put the cost in. The opening book value is the same as the cost. And the depreciation, remember this is the cost minus the residual value. In this case, it's going to be worth 8,000 at the end of 8 years. We'll divide it by 8, tell us how much each year. And put your closing book value in. Opening book value minus depreciation. Good. And the opening the second year is 71. What do you think we need to do here? The depreciation, straight line, same amount. How much is this figure? And the closing, you can press pause and go back if it's too fast for you. Once you've done that, you can fill that down. And by the end of 2024, according to us, the tractor's worth $35,000. Note that we've only had 5 years depreciation, so we have another 3 years of useful life expected on that truck. Log splitter, cost in first. Opening book value. Press pause on the video and see if you can do this. Hopefully you got the same figure. And the second year, opening is last year's closing. Using straight line depreciation, it's the same amount every year. closing book value, opening minus the depreciation, and again, easy, just fill those down. If you want to race ahead, you can see that the answers are on that second tab there. So now what we're going to do is going to put that into the financial position statement. We've got to do the note first before we do the top part. So the tractor, the cost of the tractor, just press tab to get the cost of the truck, and equals, press tab to get the cost of the log splitter. I'm going to type equals negative because this is taken away from the tractor. So remember this is 2024. So the accumulated depreciation, provision for depreciation, is the figure in 2024. Again, equals negative 2024 figure. Tab across, equals negative 2024 figure. And we'll just add those two together. So what we're doing is finding the closing book value. Oops. And you can fill that across. And we'll just, you can click on the auto sum button, and we're going to add up across, and then you're going to fill that down. Oh, that one doesn't. Hey, that works nicely. So, in terms of our non-current assets, the total value of them is 49,000, which is made up of all these costs minus what we've written off because of wear and tear, because we've had used them for a while, to give us 49, the total value. The total value of the vehicles is equal to the tractor and the truck added together, and the total value of the equipment is just that log splitter. And we'll get a total of our non-current assets. That's done. Well done.